What is going on today, YouTube? And today I'm going to talk about why investing versus paying off debt is just not that easy of a question to answer. So if you're looking into this, I'm sure you've either heard some people say, well, if you can get better returns in the market, you might as well invest. Or if your interest rate is very high, say you have credit card debt or so forth, or student loans that are around 8% or so, then you're better off paying that off. Now, there's a whole theory behind this to make it very, very simple. Now, the stock market has averaged in the last, we're going to say around 40 years, has averaged about 11.5%. Now, this is great. This is awesome. If this is going to do this forever while you're investing, while you're paying off your debt, that is fantastic. But you never know. You never know what the stock market's going to do, and that is one reason why they say paying off debt is better. For this instance, why people say paying off debt is better. If you pay off debt, say you have a interest rate of 4%. If you pay off that debt early, you save 4%. You are guaranteed that 4% return. Now, if you're investing, say you're investing and you're paying off a debt at 4%, which a debt of 4% is very low. A lot of financial advisors out there and everything else would say that is a very low interest rate, and therefore you are almost guaranteed better returns in the market just because they're getting off that 11.6 average rate of return, especially if you're compounding that for years and years, and if you're going to match through your 401k program, what so forth. But regardless of all that, let's say you have a debt at 4% interest rate, and you also have your stock market. You'd say, we'll just, for the sake of this video, we'll say an average return is 10%. Then yes, you're going to make 6%. Because you just take your 10% gain minus your 4% loss, 6%. But let's say you're investing at, we're not going to say the wrong time. Say you trust in the U.S. We'll just talk about United States index funds. Say you trust in the U.S. economy. You don't think it's going anywhere anytime soon. Then you're probably betting on this stock market, for instance, the S&P 500 index, to go up forever because low companies are going to replace high companies. So you might be okay. And time in the market provides a lot more worth than time out of the market. But let's go on the other side of things. Okay, say you just got unlucky and you're investing at the wrong time. Now you're in for the long term, but you're just watching. Say we invested in 2008. When we had between 2007 and 2008 when we had stock market crash. Now and it depends how risk tolerant you are and how much faith you really have. But can you imagine if you're investing money while you still have debt? So you have other things you could do with this money to make it better in a sense. You could pay off the debt and have that guaranteed 4% gain if your debt was at 4%. But say you're investing at the same time and you're just saying, oh, stock market's going to have great returns. I'm not worried about it because I'm going to stay in for the long term. This is a lot easier said than done. If you're investing for the long term and you're watching your money go in, you're watching it go down and down and down and down. I mean, this is a substantial loss. From 2007 to 2008, that was a 50% drop. So can you imagine you had a $10,000 debt you could pay off, or you invested $10,000 in the market. You invested $10,000 in the market and you see it go the whole way down to $5,000 in 1 year. Depending on how risk tolerative you are, and how much you can really stand watching yourself lose money while you know there's better things you can do for it, as in get that 4% guaranteed of paying off your debt. This might make you just absolutely sick and say, yeah, you did have a plan to stay in for the long term, but you're already watching it lose 50% of its value in 1 year. Especially if this is the first time you're ever investing, that's probably not going to go over too well with yourself. You're going to be like, wow, I'm going to pull out. And that's the worst thing you could have done. If, say, you pulled out at the bottom here, you lost 50% of your money, you're like, okay, that's it. When I lose 50%, I'm done, I'm out, I'm getting out. So you actually do lose $5,000 there, which you could have had all your debt paid off, but now it's going up, but you're not getting any of these gains because you pulled out that $10,000 because you didn't trust it anymore. And now you're losing all that money on the interest that you could have saved if you just paid off that debt. Now, that was just one example. Now, say you're on the reverse. Say everything's fine and dandy. You would start investing down in 2008. And the stock market has done nothing but gone up. I mean, in a year time, you could have made 50% back right there. 2 years' time, 70% on your money. 4 years' time, around 80. And then by the time a 5 year span hits, you would have been up about 100%, over 100%. You would have doubled your money in that 5 year span. So, yeah, in that case, it would have been dumb to pay off your debt. But you don't know. No one knows what the market's going to do. So if you're someone that doesn't like the debt over your shoulders, and think of it this way, you eliminate that monthly debt payment. So now you have more money to invest every month. You have no more, you don't have to worry about paying off that debt anymore. You don't have to worry about making your payments at the end of the month. You don't have to be counting and betting on that paycheck at the end of every month just so you can pay off your debt. You eliminate that debt. You eliminate about, say your car payment was $400 or $500 a month. You eliminate that $400 to $500 payment worry, and now you can use that money to invest. But you're not going to get anyone that has a clear, sure tell sign of whether it's better to invest or whether it's better to pay off your debt first. There are thousands and thousands and thousands of different variables you could look at and thousands of different things that can happen. No one knows what's going to happen in the future, and this is why this is such a hard question to answer. If you knew the stock market was going to go up and you knew you were going to get a better return, 100%, which you just won't, you'll never know that for sure, then yeah, it's a no-brainer. Invest and make up that difference. But if you, vice versa, say you knew the stock market was going to go down, then yeah, pay off that debt, save that interest, and then if it's going to keep on falling and falling and falling, then you're going to have all that extra money from that monthly payment to start investing for it to buy it at a lower rate and start going up. But I just want to point out, you don't know. That's why and getting debt paid off is such a psychological thing. It's such a great feeling to know you don't have to make that payment every month. So some people even say just do it for the psychological factor. It makes people happier. Debt is just not a good thing. It's not a good thing in family. It's not a good thing to be crunched on bills. Just listen to everyone out there. When they're saying they're living paycheck to paycheck, they just sound miserable. You can tell when you're talking to them. They feel miserable about it. They just don't know. They almost feel lost. So if you didn't have that burden of paying off that debt like they have, I'm sure you'd feel 10,000 times better. So if you really want to talk to someone, whether it's better to pay off your debt or start investing in the stock market or any other sort of investment, you should really go talk to some financial advisor that you really trust. And it might be different based on your circumstance. Now, obviously, if you have a credit card debt and you're paying 24% interest, then no one out there is ever going to tell you invest in the market. They're going to say pay that off because most likely you are never going to get a 25% return in a year in the market. Yes, there are exceptions, as in from 2008 bottom 2009. But guess what? You'd have timed that perfectly. And that does not happen too often. Throughout the history, that really does not happen that often. So I hope this video cleared some things up about paying off debt or investing in the stock market, and it gave you some other things to consider. Now, if you have debt above 10% interest payments per year, no one out there is going to ever suggest to invest before you pay off that debt because it's just not worth it. If you have something low, 2-3%, lower than 2-3%, then it might be up to debate on whether you should pay off that debt or start investing your money. So that's it for the video. If you had any questions on this, leave a comment below. I will try to answer this the best I can, or even lead you to someone that can answer it better than I can. If this video taught you something, leave a like, and if you like videos like this, subscribe to my channel, and I will see you in the next one.